Hello, everyone. I am Diane Damsky, head of the Secretariat for the Operating Principles for Impact Management. I'd like to welcome you all today to the episode 3 in the Impact Principles webinar series. Today's topic is Impact Investing and Responsible Exits, Impact Principle number 7 in action. I'm very pleased to welcome 4 distinguished panelists today, which represent 4 of the signatories to the Operating Principles for Impact Management. What you will hear during this webinar is that the way to exit responsibly and implement principle number 7 depends upon the type of organization that you are, type of investor that you are, and also the markets in which an investor invests. So with that, the 4 panelists that I'd like to introduce are Caitlin Rosser, Senior Officer of Impact and Communications at Calvert Impact Capital, Johanna Koob, Head of Responsible Investments at Zurich Insurance Company, Carmela Mondino, Senior Operating Associate for ESG and Sustainability at Partners Group, and Samuel Montero, ESG and Impact Manager at Investisseurs et Partenaires, INP. And with that, I'd like each of the panelists to introduce themselves, talk a bit about their firms, and then we will launch into the webinar topic. So with that, let's begin with you, Caitlin.
Hello, everyone. It is great to be here. Thank you all for joining us, and thanks to Diane and the Secretary for hosting this. So my name is Caitlin Rosser. I am at Calvert Impact Capital. And Calvert Impact Capital is a nonprofit impact investing firm based just outside of Washington, D.C. We raise capital from U.S. investors, retail individuals, as well as institutional investors, pool that into our loan fund, and then lend that capital out all the way, across over 100 countries throughout the U.S. Into funds and financial intermediaries across 9 different sectors. So we really have a kind of a unique private debt strategy, which is why I think we're so interested to talk about Principle 7 within the context of private debt, as well as a fund and financial intermediation strategy. So we're not lending to projects or directly to enterprises, but lending to funds and financial intermediaries. So as a provider of private debt, our exits are really primarily through the repayment of our loans. And we actually consider our borrowers' ability to repay our loan and continue to generate sustained impact at the origination stage, as well as, of course, at renewal and at final repayment. So it's at the origination stage that I'm going to actually focus probably the majority of the time on. Interestingly enough, even though Principle 7 is all about impact and exit, but of course we'll talk a little bit about that too. And actually, in fact, the majority of our borrowers do opt to renew their loans at least once, oftentimes with an increased ticket size. So we're often renewing and increasing to our borrowers, and we really only have a handful of quote unquote exits each year out of a portfolio of over 100 loans at any given time. And our renewal and increase decisions really take into account our borrowers' financial and impact performance, both kind of at the time as well as what we predicted. And that's obviously predicated on them sustaining, if not growing, the impact they've already achieved. So really kind of speaking specifically to the language within Principle 7 too. Our portfolio strategy is to build, grow, and ultimately sustain our borrowers' operations and impact. And enhancing their ability to expand their own products and services usually means that our lending relationships are years, if not decades long. And so when borrowers do decide to repay, it is often because our strategy to help them build, grow, and sustain their operations and impact has been successful. And they've gained access to the traditional capital markets that are, usually much more efficient than the private impact markets. So we kind of focus our analysis on investor contribution when a borrower does repay. And so it's actually kind of interesting that in a way our exit assessment also helps us align to Principle 3, which talks about the manager's contribution to the achievement of impact. So to actually get into the meat of the principle, the way that we assess a borrower's ability to sustain impact after they have repaid, I'm going to talk a little bit about Principle 4, which in our disclosure statement discusses our impact rating system. We call it our impact scorecard, and it's the tool that we use to project or assess the expected impact of a loan during the due diligence stage. So the impact scorecard assesses the impact that we expect our borrower to have and our capital to have. And it breaks down the different types of impact by the IMP's 5 dimensions of impact. And you can actually see an outline of the scorecard in our disclosure, and you can see the different dimensions and how it's all broken out. And so the way that we use the scorecard for origination and renewals is actually quite similar, with our investment officers projecting the potential impact and ability to sustain this impact that our borrowers have. And this emphasis really, or this analysis really emphasizes the assessment of impact risk, which is one of the IMP's 5 dimensions of impact. And impact risk is essentially the risk that the borrower won't achieve the impact expected. And this analysis also really relies on our broader credit risk process, our broader kind of credit risk review that we have during our due diligence stage, which assesses the borrower's financial performance, just like our impact scorecard assesses the borrower's impact performance. And it also assesses the borrower's ability to achieve their goals, the risk that they won't grow, the risk that they won't sustain their performance, and thus the risk that they won't be able to repay us and continue sustaining their impact beyond repayment. So this entire assessment is all incorporated into our impact due diligence process at origination before money even goes out the door. And when money, oh, sorry, Diane, go ahead.
Okay, I was going to just let the other 3 panelists introduce themselves, and then we'll get into the deep dive. That was
sure.
Thank you for that great summary of what you're doing at Calvert. Johanna, let's next go to you if you could introduce yourself and your firm, and then we'll go into the deep dive on your approach in the second segment.
Sure, absolutely. So hello, everyone. Also from my side, my name is Johanna Köp, and I'm the Head of Responsible Investment for Zurich Insurance. As the name says, we're a large global insurance company active around the globe, both in property and casualty and in life insurance, with a balance sheet of about $200 billion. Now, part of our responsible investment strategy is impact investing. And of course, we're an IFC principal signatory. But as an insurance company, we are an asset owner. So I will talk today a little bit about how we tackle Principle 7 and the exit strategy in the various asset classes that we use for impact investment. We're quite focused on the green, social, and sustainability bond market. We also do infrastructure, private debt, and private equity. So, of course, that differs a little bit how we can look at exits from that point of view. And happy to talk more about that later.
Great. Thank you, Johanna. And Carmela, would you like to introduce yourself and your firm?
Of course. Thank you, Diane. And thanks, everyone, for joining. My name is Carmela Mondino, and I'm responsible for ESG and sustainability at Partners Group. We're a global private markets investor with over 19 billion assets under management, sitting in Switzerland, but holding, as I mentioned, assets globally in private equity, private debt, private infrastructure, in private real estate. As an investor, similar to Johanna, we are a responsible investor. We embed ESG in everything we do, but as part of our strategy, we have an impact at scale strategy where we actually invest in companies that have an impact component from a product or service perspective. And so I'm going to talk about growing the impact while growing the assets. So thanks.
Thank you, Carmela. And Samuel, if you'd like to introduce yourself and INP.
Yes, so thanks, Dan, for inviting me to participate in this webinar and for allowing me to share INP experience. So I'm Samuel Montero. I joined INP in 2016 as a research officer at the beginning in order to do a PhD in economics. And now I'm the ESG and impact manager at INP. So Investisseurs et Partenaires is an impact investment group that is entirely dedicated to financing and supporting SMEs, small and medium enterprise in sub-Saharan Africa. We have been created in 2002 and we are now managed by Jean-Michel Severino since 2011. We are a team of 80 people that are mostly based in 7 African countries, and I think it's important to note it because local anchoring is very essential for us. Our mission is really to contribute to the growth and sustainable development of the African continent by financing and advising these African entrepreneurs that are seeking, of course, economic, but also social and environmental growth. We support almost 100 partner companies with financing needs ranging from 10,000 euro to 3 million euro, and that are based in several African countries. We make equity investment, which can be, of course, depending on the need, supplemented by loans. And our target is really to target and to finance SMEs. That it's what we call the missing middle in Africa. They are too big to be financed by microfinance institutions, but they are too small to be financed by traditional equity investors. And it is this lack of access to long-term financing that we are seeking to address. And our impact strategy revolves around several pillars. And of course, the main one is entrepreneurs. And we want to accompany the emergence of a new generation of African entrepreneurs, particularly in fragile and least developed countries, and mainly Francophone countries. Employment by creating decent job, clients, the value chains by creating opportunities for suppliers and distributors, gender and environmental opportunities. So as you can see, we have adopted a structured approach around stakeholders in order to have an aggregated view of the portfolio, since we invest in all sectors. So that's it for the presentation of INP, and I think after we will talk about the exits that we have done during our history.
Thank you so much, Samuel. As you can see, this is a very diverse group of investors. And if you step back, let's step back a bit and just, what is Principle 7? For those of you that may not know it as well as all of the signatories here, it states that when conducting an exit, the manager or investor shall, in good faith and consistent with its fiduciary concerns, consider the effect of the timing, structure, and process of its exit, and the effect this will have on the sustainability of the impact. So initially, most people said, well, exit, that means it's just private investment, so it's not relevant to other types, debt or other types of markets. So we clarified this because it is relevant to all markets. So an exit may include the sale of debt, equity, or bonds. It generally excludes self-liquidating or maturing instruments. But an investor may exit those types of instruments early as well if there's been some change in the investment or the investee, the governance structure, or if the impact that was targeted at the outset is nowhere near going to be achieved and the investor says this is no longer fitting or why we went into this investment. So exits, again, applies to all types of markets. So the types of considerations, I mean, you heard from Caitlin already about the types of considerations at exit. There may be some systemic ESG analysis at the exit. There may be looking at considering who is going to buy this asset at the exit. So who is this buyer? And also comparison of the anticipated impact versus the expected impact at the exit. And as you, I think both Caitlin and Carmela have mentioned, there's an interrelationship between the different principles. So you can't just look at Principle 7 in isolation. It does relate to Principle 4, Principle 3. So it will be interesting to hear how, when you all built your impact management systems and processes, how you looked at the different interrelationships between the different principles. So I did want to highlight that we all know we are operating in the era of COVID-19. And the last webinar topic was impact investing during the era of COVID-19 and the effect this is having on responsible exits. In many markets, the investees have been severely affected, adversely affected by the deteriorating economic conditions, the market disruptions, and I hope that our panelists will also address how this may or may not have affected how they're implementing Principle 7 and thinking about responsible exits and sustaining that impact beyond the investment. So with that, I'm going to ask each panelist to dive a little bit deeper into their approach. Again, I'll start with Caitlin, and I'll follow up, Caitlin, on some of the points that you made before, that you're looking at exits at the beginning of your investment, because given the markets in which you operate, the debt markets, it really is the origination where you can put this into the documentation or the ex-ante expectations of how you would exit an investment. And I'd also like you to talk about, you said that some of your exits are just natural, that some of your investees no longer need the capital that you have given them in the past because they have hit their targets and they can operate more independently. Are you seeing that this is changing a bit because of COVID-19? So, Caitlin?
Absolutely. I feel like I jumped the gun a little bit and went really into our origination assessment, so I won't spend too much more time on that one. But to your latter question, in terms of has COVID-19 changed how we're thinking about this, how our borrowers are thinking about this, it is completely different depending on the market that you're looking at. Quite honestly. We about 60% of our portfolio, 64% of our portfolio is in the US and the remainder is internationally. And across the US, it looks completely different as well. So we have, the majority of our capital in the US is lent to CDFIs, or in what in the US we call community development financial institutions. They're essentially the community bank lending infrastructure. So credit unions as well as community lending facilities. We also lend to a lot of small business funds within the U.S. And other funds and affordable housing developers in the U.S. So that looks, those different markets are being affected by COVID completely differently depending on where you're looking. And obviously, small business lending has really been hit hard. And so we've actually seen, interestingly, our small business lenders are still kind of grappling with how this is going to affect their portfolios, how this is going to affect their small businesses. There's been a lot of relief financing come in, which has really helped, I think, get the borrowers back on their feet or help them figure out how are they going to reopen, et cetera, et cetera. And a lot of the relief facilities that we've helped arrange within the U.S., we're working on 3, one in New York, one in California, working on another one. Have also really helped the small business landscape. So it looks completely different in small business than it does in affordable housing. And the CDFIs that we often lend to, the ones that are leaving our portfolio and have repaid our loan and are moving on because they no longer need the kind of capital that we provide, are issuers themselves. So they're going out directly to the capital markets. So it really, and then we can talk internationally and the conversation changes completely. So it really depends on the market that you're looking at. And I think, in terms of Principle 7 and how we're approaching Principle 7, it actually doesn't really change. COVID doesn't change how we're looking at Principle 7 or approaching responsible exits. We've always been concerned about exiting responsibly, making sure we're not leaving our borrowers, hang out to dry, making sure we're not leaving their clients hang out to dry, and that the communities need the support that they need. And that's, true now, perhaps more than it ever was, but was, certainly still true before COVID as well. So whenever we're approached with a renewal or a modification request, we always take the effect on sustained impact into account. And particularly now for renewal decisions for borrowers that are in markets that are particularly affected by COVID-19, what we're doing more frequently now is perhaps not doing a renewal at this point in time, but doing an extension so we can see what the market is actually going to look like, because we're still in the middle of the pandemic. We are not on the other end of this. We don't know what these markets are going to look like. We don't know what our borrowers are going to need and how those needs will change in the next 6 months to a year. So I think we're being even more patient now than ever, which is a lot to say because I feel like we were pretty patient providers of flexible debt financing beforehand.
That's very helpful, Caitlin. It's true that impact investors are the absolute patient capital, and they're really needed in this time because everybody is very stretched and really looking for as much help as they can get. Johanna, as an asset owner, you mentioned it's different because you're not necessarily engaged with the ultimate investee. So how you are able to influence the outcome or the impact at exit is different than what an asset manager is doing. So if you could just illuminate for us, what is your approach and how do you envision that you might be able to have influence? Perhaps you are already influencing some of your asset managers, but what do you envision do you see the market changing in that direction? Because as impact investing is growing, asset owners really do have a very large say in how asset managers are implementing impact.
Yeah, thank you, Diane. We do, and I think the way we approach it is really per asset class, because we have a mixed model of where some of the assets we manage in-house, specifically a lot of the listed debt. In private equity, we have our in-house fund of funds, so we have a team that does the manager selection. And for infrastructure debt, we're working with a variety of external asset managers, but very, very closely where we set up the program together. And the approach really is an asset class based one where we introspectively look at our role and the kind of influence we can have on either the asset manager or the underlying product. So our biggest share of impact investments is green, social, and sustainability bonds. We only count those that have a good impact theory and underlying projects, and that will report after a while. But given that that is public debt, of course, a lot of it is self-liquidating, and we tend to also have a hold to maturity strategy. So we also do sit on a lot of those assets for the time of their duration. But we do trade once in a while because portfolios shift. And in general, we're very close to the green, social, sustainability bond market. We shape a lot of the systems and the rules of the game. And we do know that especially in the secondary market, there is an overpopulation of responsible investors that also really look for that paper on purpose. So we feel that if we sell, it will actually be picked up by an investor that thinks to most of the time very similarly than we do. So we're a little bit less concerned about this asset class. In infrastructure debt, we work with some external asset managers. They work according to our guidelines. And also there, we're usually part of a consortium that directly invests into debt. And we have taken together, defined what is green infrastructure, what is social infrastructure, and also there will typically hold to maturity. There can be preemptive exits, especially triggered by a default on one of the covenants. Interestingly enough, green infrastructure is usually renewable energy, so the impact is somewhat inherent in the asset. Again, there we're a little bit less concerned because even if we do exit a wind farm or a solar farm, inherently in the asset, it won't just change overnight. I mean, you can't turn it into a coal mine. So there we're quite sure also that the asset will exist. It's a little bit different on the social side, where we also have a closer communication with our asset managers. And then lastly, in private equity, also there we select funds, we select fund managers. And similar to what Caitlin has said, there it's really in the beginning where we do have leverage. We look at all the GPs that we select from an ESG integration perspective for everything, looking at how they build their portfolios, how they structure their exits, what they do with the portfolio companies in between, what their value creation is. But then when we target impact, that of course also is quite specific. A variety of our private equity GPs are also signatories to the impact principles. That of course is a new development, but we've had a really good conversation with them also around the entire topic of signing up. And again, there we do see differences between green and social and between impact that is baked into the asset as opposed to the way in which you're managed. Just to give you an example, we do have a variety of allocations to clean tech funds. And there the impact is really derived from superior technology that can save toxins or that creates energy efficiency. And we often follow a mid-market growth strategy where of course exit is part of it. But in those tech companies, whoever acquires them, if the technology is really useful and survives, the use of concept will also be valid for the next investor. That can be a little bit different if the impact angle is around increasing policies and improving policies in switching to renewable energy, improving the operational eco-efficiency of a policy and the underlying company. And then we've seen for some of our GPs that they really have good frameworks around how they exit and how important it is for them to leave a legacy and in kind of choosing the next partner to exit to. So that is something that we look at in the due diligence. But then once we're invested, we kind of have to trust that things really happen the way we hope to, because then as an asset owner, that's to a certain degree where our realm of influence stops.
Thank you, Johanna. That's very interesting because your approach is actually quite active for an asset owner, and given you're operating in different markets. But do you anticipate that at some point in time, asset owners or investors may have more say in the actual structuring or in the structuring of a deal and in the due diligence process and get involved earlier on? Or do you still think that that's going to be a little bit tricky?
It depends on the asset class, and I guess it also depends on the size of the asset owner and the size of your project. So in the green bond markets, we were there very, very early. And of course, we were one of the investors that shaped the market and helped shape it. And then, of course, it grows. And at a certain point, you want it to be liquid. You want it to grow because that's also part of the impact theory of change, if you want. But yeah, on the private debt side, when we set up those mandates, of course, we get to write the guidelines and we get to choose the asset managers to do things the way we want them to. And also in the private equity space, it's a bit of a give and take, right? Some of the GPs you need to make a case that they take you as an investor. And on others, we've also had cases where we went in as the anchor investor and helped a vehicle come to life. And especially in that kind of situation, you're being asked, you're there from the beginning and you develop things together. Also in the private equity space, sometimes investors will be asked or will be offered to also co-invest directly. And then it depends on the setup and on the bandwidth and on the skills an investor has, on the strategy ultimately, on whether that offer is being picked up or not. But of course, the closer then the investor moves to the deal, the more say you have. So I guess the answer is, it depends.
Oh, that's very helpful. Thank you, Johanna. Carmela, I noticed in the disclosure statement for Partners Group, you have not yet had an exit for the assets that align with the impact principles. So if you could talk about your approach and how you set up your impact management systems and processes to take into account the, impending or eventual exit from investments. And also, did you then look at how Principle 7 relates to some of the other principles, because those you are probably already implementing?
Yeah. Okay. No, thank you. It's good that you said the fact that we haven't had an exit yet, but we're definitely thinking about it. So it's good, but it's good to bring it up. Maybe to your point, for us, it's really important how we define impact, right? Because to Johanna's point, she mentioned this thing around, setting up policies and procedures. For us, that's part of our ESG engagement that we do with any company that we have in our portfolio. And ideally, we embed that in the culture of the company and in the way that they conduct business. And as part of our ESG, the due diligence, when we exit, we demonstrate that we had a positive contribution so that whoever takes over continues with these practices, right? But that's for any investment, and we have conducted impact exits in that regard. And maybe we take part of the learnings from that into the impact thesis and how we look at exits. So for us, we invest for impact mostly in private equity and infrastructure, right? So I think in a way that gives us an advantage, right? Because we're only talking about investments where we're going to be able to know everything in advance, right? We're going to be able to conduct our impact due diligence, like we call it. We have a procedure that we have set up and a methodology that we set up for that. We're going to be able to control the investments value creation, and we're going to be able to also have full control of the governance, right? And this is what helps us with our impact angle. During the due diligence, we apply the IMP 5 dimensions, and where we can really, make a difference is through our contribution. So if we think to your question on the other principles, we are super active and working really closely to principle 3, right? And thinking about how can we grow the business while still growing the impact. And we're focusing on companies whose product or business or service, basically the business model is around the impact. And I think it was Johanna that mentioned that before. I think she mentioned around technologies, right? And for us, it's the same. On renewables, it's super easy. She talked about it. I used my example as well. But we have companies on our portfolio in the agriculture business that focus on offering bio solutions for the agriculture sector. And if we grow this business, if we make the company about that, then it's really hard for whoever takes that company when we exit to change the business model in a radical way that will drift away from the impact. So that's a bit how we think about it and how we operate. And so what we envision at exit is that they will not have a choice. Basically, this is going to be the company as is. We changed the company's culture, we changed the business model if it had to be changed, or we took it to the next level. And I think what is also important is to demonstrate the impact. You would be surprised about how many renewable platforms we look at, and when we ask them, but how many homes you provide energy to, or what's the equivalent of the emissions that they just have no idea because they hadn't thought about it. So just setting, walking with them and making sure that they can talk about their impact really changes the way the companies think. So that's also our thing. We're thinking around exit, being able to demonstrate that we had an impact and not only the companies have it. What do you think?
That was very helpful. I mean, you really elucidated how you built the impact management systems and processes and kind of the stepwise approach that you've taken. And just for those of you that might not be as familiar with the impact management project, it is reflected in some of the principles. The 5 dimensions of impact that the impact management project devised is incorporated into principle 4. And that's, what is the intended impact, who experiences the impact, how significant is the intended impact. And principle 3, which discusses the investor's contribution to the level of impact achieved. That is also very much in alignment with the impact management project. So for those of you that are not aware of it, that's why we are discussing this. They were one of our partners as we were developing the operating principles for impact management. So we're going to have an interactive discussion amongst the panelists. I just want to let Samuel discuss INP, and INP obviously has a very long history of exits in the SME markets in Africa. So it would be interesting to hear your approach and also talk about some of the successes you've had with responsible exits and maybe some of the challenges that you have found in these markets.
Yes. So of course, one of the challenges already to be able to exit. It's especially when you invest in SMEs in Africa, but we have been able in the last years to do a couple of exits. And of course, once you have exit or when you want to exit, the question is how to be sure that what you have implemented is going to continue after and under the new ownership. What we wanted till the beginning is really to design action plans to improve both social and environmental performance as well as financial performance. And for example, when you do actions to improve working conditions and implement access to health insurance, that reduces then turnover and associated costs. And of course, it improves the financial performance. And this kind of action, it ensures the sustainability of the measures, since it also benefits to the companies and it allows its development. It's the same when we help the company to be structured, when we help the company to be formalized. When company and employees are formalized, then it's very difficult to challenge it, because once employees have access to a formal employment contract, it's difficult to come back. And once also the company is visible to the tax authorities, it's difficult also to step back. So it's one part that is important. It's really to design action plans that are linked to the financial performance. And also all ESG issues and impact are widely appropriated by entrepreneurs. and are deeply rooted in business processes. Actions are always discussed with the entrepreneur. We agreed on this ESG action plan, and they understand the value of the measures. And the entrepreneur himself who will implement these actions afterwards. So this makes also the action all the more sustainable. And also, it's important to point out that part of our exits, in fact, was on the entrepreneur himself. So the entrepreneur bought our shares. And in that case, also, of course, this shared vision and the actions that he himself has implemented should therefore continue. Of course, also one of the first steps is also to check the profile of the buyers. So the investment team checks the reputation and track record of potential purchasers and interviews them on their intentions in relation to responsible ESG practices. So the investment team will check if there is any ESG or lab issues with potential buyer applying a KYC procedure. And as far as possible, also, INP selects buyer who allow for the sustainability of the company's impact. We say as far as possible because it's only in the case, of course, where you have several potential buyers. And in that case, INP is prepared to make trade-offs on financial profitability and does not necessarily select the largest financial offer. So it already happens that when you have two offers, you have one with a biggest financial offer, but we thought that the second offer was more aligned with the vision and the mission of the company, and we have decided to not take the largest financial offer, but to sell to the company who has a more linked vision. And of course, impact management issues are included in exit discussions with the selected purchasers. What we have tried to do, because we wanted an example of something that has almost failed, we wanted to include it in our legal documentation when possible. And to be totally honest, it was rather a mixed experience. Because by definition, an ESG clause can only be what we could call a means clause and not a result clause, to say that the buyer puts in place all the means to maintain and pursue the social approach. We thought that we would be able to include it in the shareholder agreement, but because it was large and we thought that it will be not too complicated, and in fact it was the opposite, because this type of clause is in fact too vague, which is hated by jurists, and in fact it was often refused, even when it was the entrepreneur himself who has bought us out. And this type of clause is considered as too vague to be part of a legal document. So it was something that we have tried in order to think if how to be sure that it will continue after us, because by definition, once we are not on the board, we do not have any access to information, and we wanted to put it more clearly on the document, and in that case, it's starting to be challenging.
Thank you, Samuel. That's very interesting that from a legal point of view, that clause is considered too vague to be implementable. And do you, given how the market is growing and evolving, do you envision that this may not be the case in the future, that more people are headed in that direction? So maybe there will be a different legal view on these types of clauses. I'm too optimistic. I don't.
No, maybe, I hope so. But in fact, since the legal documentation is really something done with also lawyer and jurists, they need to be sure they understand the same thing. And if it's unclear and they don't know what you really want to put in that clause, it's difficult. So the next step, but what we haven't done, maybe we wanted, instead of putting it in the shareholder agreement that is, let's say, an official document, maybe we could sign a kind of a charter. Also, like this, we are sure that we have discussed with the new buyer about these issues. And maybe with a different form of document, it could be easier to to do it, because in any case, in fact, we know even if it's in the legal shareholder agreement, you will not be able to do anything at the end. So I'm not sure, maybe we could think about another document. And I think this kind of, the point of putting it in a documentation is to be sure that we have discussed about it and that the buyer know what we wanted to do, what is the vision of the company. And what is more important, in fact, is to have something written, and maybe it could be done with another document.
Thank you. So now I'm going to open this up to all the panelists to discussion. I'd like you in your comments to talk about how have the principles, and especially Principle 7, helped you in your impact management process and perhaps with responsible exits. And since both Samuel and Caitlin mentioned, the documentation, like for Calvert, it's more at the origination part, and you're trying to the shareholder agreement. Is documentation and an evolution on the documentation side, is that one of the critical pieces missing to support responsible exits? And I let anyone respond to that.
I'll jump in super quickly, and then would love to hear from others as well. I think one of the things that I think is missing from the industry is that understanding that exits don't actually happen at the end, or the consideration of responsible exit doesn't start at the end, it starts at the beginning. And that, I think, is something that we as an industry really need to wrap our heads around, and it has taken a little while. And particularly in the private debt space, I think, Samuel, the process that you outlined of how you think about an exit is how people typically think about an exit. And we're having to kind of constantly challenge that in the private debt space. So that's probably the biggest challenge that we saw. I think we're overcoming that challenge. And then Diane, to your point and to your question, documentation is certainly becoming, I think, the next challenge that we have to overcome. Once we've got documented, and I think generally accepted by the industry, by the verification firms, because this is a very long conversation we had with our independent verification firm. Once we have that process accepted, that you can think about a responsible exit at origination, then moving into, okay, well, how do you document that at origination and at repayment as well? And that's actually where we're moving in our next steps to even better align with Principle 7, is how do we document the decisions made at exit? How do we document the actualized impact versus the impact we projected at origination? How do we document the borrower's perspective, in doing some kind of impact at exit interview, case studies, that sort of thing. So that's actually what we're focusing on and have been focusing on for the last few months, and we'll kind of document over the next few months as well. So would love to hear from the other panelists if you're having similar experiences, similar challenges.
I mean, actually, well, from my side, I would say it's it's definitely a challenge, or you could call it that way. But in our strategy, we are talking about companies that other investors that do not have necessarily an impact strategy would still acquire, right? So I guess maybe this is the difference there. So we still need to, the trade-off that Samuel mentioned is not really an option for us, because we're promising both impact and returns. So in that context, that's where the long-lasting value creation comes into place. Maybe to your point, Caitlin, that there is around reporting. So the picture that we take at the beginning and the journey that we took the company through, and I think everyone has different names for the same thing, but it's about the journey and the value proposition basically of the company. So that's how we are tackling it. Just because we don't have this other option, although it would be something that we're finding challenging, and we're hoping to think more about is, well, if the impact space keeps on growing, are we going to be able, is there a premium for having an impact company and not an average company, right? But that's a challenge that we still haven't been able to solve.
I can probably that the formalization does help to a certain degree, right? Because thinking about exits in the context of asset classes is something that happened implicitly for us. But I think the principles did help to formalize our existing process and see where we can put it in and where we didn't. And especially with Principle 7 exit, we did end up sitting there a little bit like, how do we do it? And does that back up the entire process that we had in place? Is there something we might want to fix? And have we thought a bit about it as structured and explicit, or was it more an implicit thing? So it did help to think that through and formalize it, just also for ourselves and to the external world. And what I can say, I mean, in the private equity space, in the GPs that we invested with, where we do see they really have governance around the exits and have a strategy around upholding their legacy and wanting to make sure that exits function in a way that the impact theory does hold up. We have seen them back that up also in the documentation. So in half-year reports, for example, when exits happened, we could see that in the documentation that described the exit, there were also points speaking about what the assessment is of the survival of the impact through the exit, going of the company kind of changing hands, going to the next owner. And that was really, really interesting to see. So that has happened before, but I think also for those managers that have signed up to the principles themselves, I guess the documentation and the making things more explicit, the kind of thinking them through could be helpful.
Yeah, I fully agree with all of you, and especially with Caitlin. I think what is important is really to say that what we are doing is deeply rooted in the business of the enterprise, and we cannot think the exit at the end, in fact, but we really need to think it during all the project, because we need also to admit when we talk about exit that we cannot be sure once we leave what is going to happen. And of course, we have all these principles, and we all want to do it correctly. But once you are not in the company, you are never able to be sure what is going on. So the best way to be sure that it's going to continue is really to build a strategy and to implement actions that make sense. And of course, for example, if you pay some solar panel, I'm sure that the new buyer will not replace it to put fuel generator. It makes no sense. And in that case, you are sure that it will continue after your exit.
And all of those comments, it makes perfect sense that it sounds like both from an asset manager as well as an asset owner perspective, the intention up front really does make a difference to how the exit actually transpires. It does seem that, I mean, one of the goals of the impact principles was to provide more transparency into the impact investing market. And one would hope that with an increase in assets in this market and a movement of more asset owners into this market, that this amount of transparency would also put more eyes on responsible exits, and that this would become more de rigueur in the market and expected. Whereas it was relatively new and most people were having a hard time balancing the double bottom line. But one would hope that as this market grows and evolves, that this is one of the natural outcomes of impact investing, that responsible exit becomes really the appropriate approach and the expected approach. So do any of you have more comments for each other or any questions for each other, as a matter of fact, since you're operating in different markets? Well, do you? Oh, I don't want to interrupt. Well, I want to thank everyone for being with us today. I think this was a great discussion. It really, really illuminated, what it means to have responsible exits, what it means to be an impact investor and take these into consideration, be you asset manager or asset owner. So we welcome anyone's comments. If you would like to get in touch with us, it's the impactprinciples.org website. And we truly value your interest in the principles. And for those of you that may want to consider becoming a signatory, please reach out to us. And again, I want to thank Caitlin and Johanna, Samuel, and Carmela for your time today, and it was a great discussion. So thank you so much, and have a great day.
Thank you.
Thanks.
Take care. It was a
Thank you,
pleasure.
Diane. Thanks all.
Ciao.
Perfect.
Bye-bye.
Bye.
Bye.
Bye all.